All right. Thank you so much for joining me on this cold, chilly afternoon to talk about, are your finances ready for a recession? And, just real quick, right out of the gate, I want to say I want to keep this presentation fairly high level. I'm going to bring up some topics and some ideas that maybe you've heard of and you've maybe read a little bit about in the news. But if you want to dive into this more, I'm happy to chat offline. Let's find a time to connect. I'm going to go through this pretty quickly. Again, I just want this to be thought provoking and give you some context for what's going on. And I think the theme for today really is going to be perspective. Let's keep things in perspective so that whatever we read in the media or the news or social media, that you can look at it from hopefully an evidence-based approach, which is how I like to approach things. And quickly, just for the agenda today, I want to give a brief look in the rearview mirror on the history of the markets and the history of recessions over time. And I'm also going to talk about some investment considerations, what you should think about as we go into this potential recession in the not so distant future. I will get into some specifics around some strategies that you might consider for your portfolio. And then, I also want to talk about cash flow planning. There's this bucket strategies, short-term, mid-term, and of course, long-term that we'll bring up today. And with everything that's going on, there's some emotionally charged conversation topics. And when it comes to investing, like I just said earlier, I would love to try and take emotions out of the equation if possible. So I want to talk about those biases and the way that we're all hardwired as humans when it comes to investment management, portfolio construction, and of course, financial planning. And that'll lead us to our last topic, developing a plan, making sure you've got at least some idea of what you would do, in those what if scenarios. And, I've said it a million times, failing to plan is essentially planning to fail. So if you have someone in your corner, a financial coach, a financial planner that can help you figure out what steps you should take, that's going to make this journey a lot easier. So with all that said, I'm just going to dive right into it and hopefully you get some takeaways today. So let's talk about the history. I think this is really important, and if you take anything from this presentation, this is something that at least keep in the back of your mind as we learn about different recessions over time, looking over the past, let's call it 100 years. The green shaded areas that you see there on the screen, those were the official recessions that we saw. And I think it is also important to note, back in 2020, just a couple of years ago, that technically was called a recession, and it was the shortest recession that we've got on this whole chart here. And I wanted to show this today because this gives us the ability to zoom out, get that bird's eye view, get that perspective of when we look at it from this big long-term view, we see that, there were these ups and these downs, and during those green shaded areas, you can see those dips, but over time, we got through it. And the different recessions were caused for different reasons, and they lasted for different amounts of time. But, we have this faith in the U.S. and the world economy. We're going to figure it out. And that's where, I think the mainstream media doesn't do the best job of really looking at this long-term perspective. And then that's what I wanted to bring this up on today's presentation. If just looking at all these different periods of time, of course, it was painful to go through it, but we did get through it. So let's just kind of let that maybe sit there in the back of the mind throughout the rest of the presentation, because it's important that you look beyond the headlines. And this is where, when you see a headline, it's not really trying to convey information. It's trying to get an emotional response or that knee-jerk response out of you. And the daily market news and the commentary, it really can challenge your investment discipline. And this is where the anxiety comes from when we look at these different headlines. It's saying sell now, the recession's coming, and all these different, I think, trigger words are going to be something that, if you can just kind of digest it, look at it, and realize that, maybe that's what's happening in this exact moment, in this minute, we're really planning for multiple years. So this is something that I get it. This is what the media does. Not really anything we can do about that, but Again, when the headlines maybe unsettle you, look at the source. Always try to maintain a long-term perspective if possible. And this is where I kind of get to the different strategies. And I'm going to use some jargon today. I'm going to use some lingo in the financial planner world that it really might sound like a different language. And I get that. I want to be your translator. I'm going to use this terminology today. I'll try to explain it quickly. But again, if you want to connect offline and dig into this, let me know. Let's find a time to connect. But when we're thinking about your investments, your nest egg, your retirement accounts, your investment accounts, what can we do to at least make sure we're prepared for a market downturn or a coming recession? Well, it all starts with asset allocation. And just real quick, the asset allocation, that's the ratio of the stocks and the bonds that you have in your portfolio. And, the ratio, maybe it's 60-40. Maybe you've got 60% in stocks, 40% in bonds. That mix is what determines, how much risk you're taking. And the amount of risk is different for everybody, depending on when you want to achieve your goals. That factors into how much risk you should take. But also just, from a personal perspective. If you've got concerns that are keeping you up at night, maybe your portfolio is too aggressive and we need to dial back that risk. But that overall market exposure and risk, that takes some kind of careful construction and then some maintenance along the way just to ensure that we're tracking towards those goals. And that percentage of stocks to bonds, there's different strategies that we'll implement during a market downturn. And rebalancing is a really big part of that. And that is rule number one of investing. We want to make sure that we're buying low and selling high. And rebalancing is this mechanical discipline to ensure that we're selling high and buying low. So I'm going to talk a little bit more about that in a second. But the other, I think, general concept, and maybe these are words that you've heard before, the importance of diversification. And you've got different types of investments in your portfolio, those uncorrelated assets, which means when one of your investments zigs, the other one zags. That's what we mean by uncorrelated. And, just a little bit about that. You've got to have international exposure. You've got to have these different types of investments in the portfolio. And real quick, I want to talk about taxes. So from a tax perspective, there are some strategies that we can implement during a downturn in the market, during a recession. I do emphasize these are silver linings, very thin silver linings to a market decline. Of course, we would love to just have the portfolio and the stock market go up and up and up year after year, but we know that's not true. So when we are going through a downturn, there's different things that we can do from a tax perspective that could, offset some of the taxes that you pay in the current year and in future years. So let's dig into that a little bit more. I've hinted at this, that ratio of stocks to bonds and how much equity should you have in your portfolio. I think this is an important place just to pause quickly too. I'm going to use the word equity and stocks interchangeably. They mean the same thing. So when you hear someone talk about their equities, they're talking about the stock portion of their portfolio. And the different factors that go into determining what is that right mix of stocks and bonds, it comes down to those different bullet points that you see on the screen there. Time horizon. Again, how long do you have until you need to access this money, or will you use your investments for different goals? And that's budgeting and cash flow needs. And the risk tolerance, I'm going to keep using that word tolerance, is different for everybody. So, if we map it out, we do all the math behind the scenes and we say, hey, look, the financial plan that we've built says that you should have this percentage of stocks and bonds in your portfolio. That's great. That works on paper. But going back to what I said earlier, if this gives you stress or anxiety, you've got too much in stocks or maybe too little in some cases, that is a conversation that you need to have, again, with the long term in mind and doing our best job of trying to take emotions out of the equation. It's easier said than done, but that is something that I wanted to make sure that I dig into a little bit more in a second, because it really is all about finding that balance so that you have the staying power or the discipline to ride out the storm. And this isn't a set it and forget it type of model where you never look at it again. And this isn't a, hey, let's bury our head in the sand and do nothing. No. A well-constructed plan should, at least make the assumption that we're going to go through these downturns so that we can ride out the storm knowing that we've got our plan that's supporting that. This doesn't mean that if you don't have a plan or if you've never properly looked at your investment lineup, that you should just do nothing because the recession's coming. That could be a time to revisit, your half-constructed plan in some cases. So this equity ratio, stocks to bonds ratio in the portfolio, that is one big component of figuring out what you should do when it comes to different market conditions. But, what it really comes down to is, all right, well, what action should you take when the market changes? And I am emphasizing today a market decline, a recession. But these same concepts apply in the other direction. So if the market goes up tremendously without us, really keeping a close eye on what's happening in the markets, this is another place for us to learn about rebalancing. So when we talk about rebalancing, well, first I need to figure out, all right, well, how did things get out of balance in the first place? And this is the construction of the portfolio. Again, you've got different stocks and bonds, probably mutual funds or ETFs. And all of a sudden, let's say the stock market does incredibly well. It just goes up faster than you expect. And if your original target, again, I'm just using some generalized ideas here. Let's say that 60-40 is your original target, 60% in stock funds, 40% in bond funds, and then the stock market goes up. So all of a sudden that 60-40 becomes a little bit closer to maybe 70-30. And, that's a great thing that the market's moving in the right direction. But in that case, because of the careful planning you've done, 60-40 is a better target. So that's when you rebalance it. You want to bring it back down to 60-40. And that's what could happen in the other direction. So a 60-40 portfolio might become closer to 50-50. And that's just where you want to make sure that you step in front of that and bring it back up to 60-40 in a very mechanical way. So this is a mechanical discipline that is not predictive in nature. It's not trying to guess what's going to happen. It's just looking at the plan and ensuring that we stick to it. And if things get out of balance too far, all of a sudden your risk tolerance might not match up to what's happening in your portfolio. So again, that's why we call it rebalancing. And I'm going to probably sound like a broken record before the end of this, but rebalancing is just ensuring we've got this framework for doing rule number one of investing. We want to sell when things are high and then buy when they're low. And when the market's going up, that's what we're going to do. We're going to sell some of the best performing parts of your portfolio, and then we're going to buy some of the least performing. And that's where, another theme of this presentation is that emotional component. If all of a sudden, this part of your portfolio that's going up and up and up, and you've got this plan to sell it when it hits a certain point, that almost feels counterintuitive because you're like, well, hold on. Why am I selling the one good thing in my portfolio and then buying the thing that's doing the worst? But again, that's why you've got this mechanical framework to get that done so that we're selling when it's high and buying when it's low. Now, here's another buzzword, diversification. This is something that I'm sure you've heard at some point. You must diversify your portfolio. Don't put all your eggs in one basket. All these different idioms around, well, yeah, having a diversified portfolio is really important, but why? And there's a lot going on in this chart. I totally understand that, but this is what we've nicknamed the periodic table of investments. All it's highlighting, and as you can see there, the different colored boxes represent different asset classes, or in other words, different types of investments. So you've got some of them investing in large U.S. companies, some of them in small U.S. companies. Some are international, emerging markets, real estate. You kind of see where I'm going with this. Each year, if we went calendar year by calendar year, there's different asset classes that performed better, and then the next year, maybe they perform the worst. And you don't know which one's going to be the best performing asset class. So this is why it's important to diversify your portfolio. Have a nice mix of all these different components. And with rebalancing as a part of your plan, you'll ensure that that risk profile that we're trying to match to your risk tolerance is doable over time. But this is one where you don't want to just circle the best performer on here and say, let's invest in that, because the next year it might be totally different. Now, taxes could be an entirely different webinar, a different presentation. I could spend a whole lot of time talking about taxes. I'm just going to highlight a couple of ideas here today. When you're thinking about retirement planning or just really your expenses and your budget, taxes are a part of that. Love it, love them or hate them. I'm guessing most people don't love them, but taxes are a big part of our budget. And we want to be as efficient as possible when paying taxes. There's no way to completely avoid them, especially if you're building wealth in your investment accounts, your retirement accounts, they're taxed differently. So when you think about over the long term, ideally, hopefully you want your investments to grow. I think that's what we're all trying to do here. But paying taxes on those gains can be done, I think in a really smart way. And one concept that we can implement during a recession or during a market downturn is this idea of tax loss harvesting. And this is, again, I would call this another one of those silver linings to a market decline. But tax loss harvesting is just realizing, okay, a portion of your portfolio is down. And this would be, to be clear, not a retirement account. So I'm not talking about IRAs or 401ks. I'm talking about just a regular taxable investment account. If you see that your investments are down from your original investment, they're at what we call an unrealized loss, which means they're at a loss, but you haven't realized them, you haven't sold them or done anything with them. Well, there's this idea that you can sell them at a loss on purpose and capture those losses to offset gains. Or in other words, harvest those losses to help offset any gains that you might experience in the current year or more than likely in future years. And this is a long-term strategy, to be clear, because what we're trying to do is set ourselves up so that in the future, when the markets turn around, if you do things correctly, you can stay invested, you can still keep that momentum in the portfolio, and then in the future, those gains can be offset with the losses you experienced this year. Now, I want to put a big asterisk next to that. To do this correctly, you've got to follow some very specific rules. If this is something that you want to consider in your portfolio, let's definitely find a time to chat. Because, ultimately, on the idea of risk, I love the bucket approach. And that's what I want to share with you today. And it's, really, I think, a generalized concept. But you think of your investments, think of your portfolio along a time scale. You've got short-term, mid-term, and long-term goals. So the way that you should, I think, take risk in your portfolio is the longer-term goals, the stuff that's many, many, many years down the road, you can be more aggressive with. You can be more risk tolerant with those investments because you've got time on your side. The market's going to go up, the market's going to go down. Over the long term, you can experience that growth and not worry about the short-term ups and downs of the market. Well, that's totally different for any short-term goals. If someone tells me, hey, I'm going to buy a house next year or I'm saving up for a car, where should I invest that money? If it's really, really short-term, let's not take any risk with it. That's cash or CDs. It's something that you don't have to worry about market ups and downs because you're going to use that money in the not so distant future. And then the midterm bucket, it's kind of this combination of both from a risk perspective. So I love this idea. This helps us kind of think about how we invest or what we do when we're building a portfolio with different goals in mind. And that's the name of the game when it comes to financial planning, is ensuring you've got those goals matching up to your different investments. Because I've hinted at it throughout this whole webinar so far, but there are emotional considerations that come into play. We get it. We're not robots. We're not calculators. The emotional component is something that we need to recognize. I think we need to start there and just recognize that our emotions are going to come into play. And then, of course, let's try to rationalize what we're going through. What you see on the screen there, I think this is the emotional roller coaster that investors go through during different market conditions. It's this time period of, all right, when things are starting to go well, there's this optimism. And then when the markets are doing really, really well, there's this elation. And then all of a sudden things change and there's nervousness and fear that comes into play. And what we've found is when you look at when people are buying and selling, it is tied to emotions in a lot of ways. That's counterintuitive to what you think would happen. But when there's this elation, let's look at that part of the roller coaster there. that's when the stock market and the investments are really, really high. And that's when people tend to feel better about buying. And then all of a sudden the market turns around, it goes down, and then you're selling when the recession's in full swing or the stock market's down a lot. And all of a sudden you've just done the opposite of rule number one of investing. All of a sudden you've bought when things are high and then sold when things are low. And that's because that little voice in your head or that gut feeling, it led you down this emotional path where you're not looking at the mechanical framework of investing. You're looking at, all right, what do I feel like doing? And this is, I don't want to blame anyone, but it's just that humans are not hardwired for this type of disciplined investing. And it's, I think, a lot with the biases that we are hardwired with. The market tanked and I should have seen that coming. I can't tell you how many times I've heard that. Of course, hindsight bias, or hindsight's always 2020 when it comes to different market ups and downs. Or my research confirmed, yeah, this was a great stock to own. All of a sudden, if you did a little bit of research and that stock or that investment went up, there's this confirmation bias, and you think, oh man, I'm the greatest investor since Warren Buffett. When, yeah, all of a sudden, you might have gotten lucky, or this just kind of gives you that overconfidence. So when people follow their natural instincts, oftentimes they tend to apply faulty reasoning to investing. And that's, I think that's my goal and that's my job, to be an objective third party, to try and look at things objectively, and then build a plan around that we can stick to. And for all the clients that I work with, I try to be that person in your corner, to be that sounding board, to ensure that we're not getting caught in any sort of emotional traps. And this is just going back to, I think, some of the basics of focus on what you can control. Create that plan and make sure that it is going to fit your needs and it's going to fit that risk tolerance. Diversification, I think, is the name of the game. Diversify not just here in the U.S., but around the globe. And looking at the expenses and the taxes, that's something that we can plan for, we can map out, we can budget for. And what specifically around taxes, there are some ideas that we can implement to save money on taxes. And this is easier said than done, staying disciplined throughout the market downs and the dips and the swings. But this is where I want to offer that guidance. I want to be here if you do have any questions. And that's where, if you are still working, for example, and you've got the ability to contribute to a retirement account, pre-tax, like a traditional IRA or a pre-tax 401k, or maybe you have the Roth IRA or a Roth 401k. These are great ways to really take advantage of a market downturn. So if you're still working and you've still got the ability to save, looking at recessions isn't always necessarily a bad thing if you can still contribute. Now, there are limits on how much you can contribute based on your income, so we've got to keep that in mind. And when we think about retirement planning, specifically with these IRAs and 401ks, you can save, and then we've got to start talking about distributions if it's a pre-tax, like a traditional IRA, starting at age 72. Those are your required minimum distributions. Or if it's a Roth, there are no required minimum distributions if it's in a Roth IRA. Now, if it's a Roth 401k, that's a different story. We've got to make sure that you do take distributions or roll it out to a Roth IRA. And if you're retired, this is just the importance of cash flow planning, ensuring that, I think my goal and my job is to put together a plan so that your money can outlive you. And rebalancing, this automatic, I think, mechanical discipline around rebalancing is really important. We do take emotions out of the equation when it comes to that. And specifically, around required minimum distributions. This is just, I think, a simple reminder, but if you are taking RMDs from your retirement accounts, ensure that you've got the tax withholding set up correctly. So if that's 10, 15, 20%, whatever it is, you can have that automatically done from those distributions. And also, if you're charitably inclined, your required minimum distributions up to a certain amount can be directly given to nonprofits, to charities, and that will come out as a tax-free distribution. Now, you've got to do that in a very specific way, so let's chat if you want to do that. And then, there's different ways to do Roth conversions, and this is something that during a market downturn, you can do a share conversion instead of a cash conversion. Again, I think I'm using a lot of jargon today, slightly on purpose, just to hopefully spark your curiosity. And last thoughts. I hopefully you're going to leave today and just know that diversification is important. know yourself, figure out what's important to you, figure out what you want to do with your retirement planning, your retirement goals, and then, of course, hire a professional, put together a plan that is going to work really well for you. So, quick update, quick webinar today. I wanted to get in front of everyone because I do think it's really important that you keep perspective in mind, that you understand that what you hear in the news, or with Thanksgiving just around the corner, you also realize that when you're talking to friends and family, they're going to say, oh, doom and gloom this, or hey, the apocalypse is coming. All of that makes its way into conversations. Or what you might want to also think about is whenever you're talking with friends about investing, there's also this tendency for people to talk about their winners and not really bring up the losers. And again, I think that's another human biasy that we love to talk about when we did well. And of course, we're not going to talk about those times we didn't do so well. So take any sort of success stories from your friends and family with a grain of salt come these holidays, and just know having a well thought out financial plan, that's going to get you through these market downturns. So I do want to open it up. If anyone has any questions, there is a Q&A box for you to ask some questions. And of course, hopefully we're all connected in some regard. So if you want to chat offline, let's find a time to connect, and I can dig into any of those topics a little bit more. So I'll just leave it open for a couple of minutes here. Oh yeah, and I got one great question. I covered this quickly, but talking about contribution limits to IRAs and 401ks. So I'm glad you brought that up, because again, one of these silver linings to the inflationary environment that we're in, next year the contribution limits for how much you can put into a retirement account is going up. And they're going up because those limits are tied to inflation. So again, if you're still working, if you're still contributing, this is a fantastic time to put as much as you can into your retirement accounts. And I think we're getting a little bit of a break here where we can add more money starting in 2023. I thank you for joining me this afternoon. This was fun. Hopefully you learned something, or at least you have a couple of takeaways from the presentation. And I'll try to do some more informational and educational events going forward. And if you have any ideas on what you'd like to learn about, please let me know. But my name's Alan Hensley. I am a wealth advisor with Merriman Wealth Management. And yeah, thank you so much for coming today. All right, bye-bye.